Bank of Canada raises policy rate to highest level in 22 years to 5%. The U.S. Federal Reserve will likely also increase by 0.25% later next week. The Bank of Canada has raised its benchmark interest rate by 25 basis points to 5%, reaching its highest level since 2001, due to concerns about a potential stall in inflation, reports Global News on July 12, 2023. The decision was expected by many economists, who noted the resilience of the Canadian economy and the likelihood that annual inflation would not fall to the central bank's target of 2%. Inflation has decreased to 3.4% in May from a peak of 8.1% in June 2022. But the Bank of Canada is worried that a tight labor market and a strong economy could hinder efforts to control inflation. The central bank now anticipates inflation to hover around 3% for the next year, gradually declining to 2% by mid-2025, which is a later time frame than previously projected. Economists suggest that there may be another rate hike after the summer. The Bank of Canada has also released a revised monetary policy report, adjusting expectations for economic growth. It expects GDP growth of 1.5% in the second and third quarters of 2023. However, some economists believe the economy could underperform, potentially allowing the central bank to keep its policy rate unchanged for the remainder of the year. The rate increase will raise borrowing costs for Canadians, impacting homeowners renewing mortgages and those with variable rate loans tied to the central bank's benchmark rate. The Bank of Canada has raised its policy rate by a total of 4.75 percentage points since March 2022. As predicted previously, the Bank of Canada has raised the benchmark rate to 5%, and the U.S. Federal Reserve is also predicted to raise rates by 25 basis points later next week.
U.S. Federal Reserve will raise rates in July, and one more time in 2023, further crashing U.S. and Canadian housing markets. The Bank of Canada interest rate is influenced by various factors, and one of those factors is the United States Federal Reserve interest rate. So when the U.S. Federal Reserve increases their bank rate, the Bank of Canada takes note, and will, more times than not, also raise rates. Near the end of this video, we'll take a closer look at why the Bank of Canada closely monitors the U.S. Federal Reserve's interest rate moves when considering its own rates. First, how do we know that the Federal Reserve will hike the bank rate in July? They have basically been telling us since they paused their rate hikes last month. Here's what recent news articles have been saying. Job gains slow, but rising wages, low unemployment keep Fed hikes on track. According to an article published by Reuters News on July 7, 2023, the job gains in the United States were slower than expected in June, indicating a deceleration in hiring compared to previous months. However, the report highlights that the steady growth in wages and a slight decrease in the unemployment rate are likely to support the Federal Reserve's plan to raise interest rates at the upcoming July meeting. Despite the lower job gains, the average hourly earnings continue to increase, indicating that the labor market remains favorable for workers. The article emphasizes that wage growth remains higher than levels the Fed would prefer in its efforts to achieve the 2% inflation target. While the pace of hiring has slowed, the economy continues to add more jobs than new entrants to the labor market. The report also mentions that traders in contracts tied to the benchmark federal funds rate have increased their expectations of a rate hike at the July meeting, considering it almost certain that the Fed will raise the rate. The article concludes by noting that the Fed's focus on the labor market is crucial in balancing policy decisions to tackle inflation without negatively impacting workers. Federal Reserve minutes reveal that some members wanted to raise interest rates last month. On July 5, 2023, an article by the Associated Press reveals the divisions among Federal Reserve officials regarding interest rate hikes. The article states that some officials were in favor of raising the Fed's key interest rate by a quarter point at the last month's meeting to address high inflation. However, the central bank decided to forego a rate hike at that time. The minutes of the meeting indicate that the support for a rate hike was a minority view among the policymakers, and it is uncommon for the Fed to mention dissenting opinions in the minutes. Despite the decision to hold rates steady, the article highlights that the committee signaled the possibility of raising rates twice more this year, potentially starting in the current month. The divided views among officials reflect the ongoing uncertainty about the economic outlook and the need for additional information to guide policy decisions. Federal Reserve signals determination to raise interest rates after June pause. The Federal Reserve has signaled its determination to resume interest rate increases, according to an article by the Financial Times on July 5, 2023. The minutes from the June meeting of the Federal Open Market Committee reveal that almost all officials expressed the view that additional rate hikes would be appropriate. The article emphasizes that the tight labor market and the presence of upside risks to inflation were cited as key factors influencing the decision. Some officials even supported a rate hike in June, although the committee ultimately decided to hold rates steady. The article notes that the Fed expects subdued economic growth for the remainder of the year, and the staff's forecast suggests a mild recession followed by a moderately paced recovery. Despite the pause in rate increases, the Fed remains committed to tackling inflation and has indicated that more rate hikes are likely in the future. After brief pause, Federal Reserve looks poised to raise interest rates again. The Federal Reserve appears poised to raise its key interest rate following a pause in June, according to a CBS News/AP article on July 5, 2023. The minutes from the latest meeting indicate that some officials favored a quarter-point rate hike, although the committee ultimately decided against it. The article highlights that the unanimous decision to hold rates steady is relatively uncommon for the Fed to mention dissenting opinions in its minutes. However, the presence of differing views suggests that the committee is leaning towards raising rates in the near future. The article mentions that most officials projected at least 2 more rate hikes this year, with just 2 officials foreseeing no change. The Fed's focus on addressing high inflation is underscored by the strength of the labor market and the view that more aggressive action is necessary. While the central bank paused in June, economists and market participants widely expect further rate hikes in the coming months. Why is the Bank of Canada interest rate so dependent on the United States Federal Reserve interest rate? There are a few key reasons why the Bank of Canada closely monitors and considers the U.S. Federal Reserve's actions when setting its own interest rate. Economic integration. Canada and the United States have a high level of economic integration. The two countries share a large trading relationship, with a significant amount of goods and services flowing between them. As a result, changes in the U.S. economy can have spillover effects on the Canadian economy. Interest rates play a crucial role in determining borrowing costs and can affect consumer spending, business investment, and overall economic activity. Therefore, the Bank of Canada pays attention to the U.S. Federal Reserve's rate decisions to understand the potential impact on Canada's economy. Exchange rate and capital flows. Interest rate differentials between countries can influence currency exchange rates and capital flows. When there is a significant difference in interest rates between Canada and the United States, it can attract or repel foreign investors seeking higher returns. This can lead to fluctuations in the exchange rate between the Canadian and U.S. dollars. To avoid sharp currency movements that could disrupt trade and investment flows, the Bank of Canada may adjust its interest rate in response to changes in the U.S. Federal Reserve's rate. Market expectations and confidence. Monetary policy decisions, including changes in interest rates, can have an impact on market expectations and investor confidence. If the U.S. Federal Reserve takes a certain stance on interest rates, it can influence market participants' expectations for future economic conditions. This, in turn, can affect borrowing costs and investment decisions. The Bank of Canada considers these market dynamics and adjusts its interest rate to maintain stability and manage inflation expectations in the Canadian economy. Global financial system. The U.S. Federal Reserve plays a central role in the global financial system, and its policy decisions can have far-reaching effects beyond its borders. Changes in U.S. interest rates can impact global financial markets, including bond markets and commodity prices. These developments can have indirect consequences for Canada's economy and financial stability. Therefore, the Bank of Canada closely monitors and responds to the U.S. Federal Reserve's actions to ensure the stability of the Canadian financial system. What do you think? Will the U.S. rate and Canada's rate both increase further? Let me know in the comments. If you found this video and information useful, Please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.